I think that gets to what these people are talking about, because since early October, the silver futures curve has flipped into sustained backwardation, and it's not normal. It's unusual to see that in silver, period. And it's one of the clearest signs of I guess you could say, physical scarcity. Along with multiple attempts to restore contango, where the futures price is higher than the spot price.
A direct consequence is the fact that we're in a structural supply deficit. Other things to look at: you can look at the lease rate on silver. You can look at the lease rate and the amount of shorts available on SLV, which is strictly paid.
Physical silver is tightening worldwide, and a veteran precious metals investor, Andy Schectman, warns that what's happening beneath the surface could disrupt markets in ways most investors aren't prepared for. Andy Schectman emphasizes that while not everything you read online is accurate, there are genuine trends shaping the silver market. He notes that governments worldwide are increasingly treating silver as a strategic asset. For example, the US has designated silver a critical mineral, China requires permits for all silver exports, and the European Union has done something similar. Schectman points out unusual market behavior as further evidence of scarcity. Since early October, the silver futures curve has flipped into sustained backwardation, a situation where the spot price exceeds futures prices, which is rare and indicates that immediate physical demand is surpassing expected supply. With just days remaining before the December contracts expire, he observes that investors appear to be scrambling for physical silver, reinforcing the idea that supply is tight and demand is strong. While he doesn't predict an imminent market upheaval on January 1st, he believes the conditions point to potential stress in the system if these trends continue. Andy Schectman highlights a broader shift at the institutional level. He notes that major financial figures, including chief investment officers at Morgan Stanley and Bank of America, are now recommending substantial allocations to gold. This represents a remarkable change in strategy, given that many top money managers are unfamiliar with precious metals. Schectman believes that if even a small portion of institutional traders act on these recommendations, it could have significant effects on premiums and availability in the retail market, signaling that a major reevaluation of precious metals is quietly taking place beneath the surface. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Well, I think, a lot of the things you see online have truth in them. A lot have a little bit of supposition or maybe overblown in some respects. I don't think that January 1, the system blows up. But you can look and see, let's just suspend retail for a moment and talk about, the U.S., of course, making silver a critical mineral. The Chinese government made silver a supervised commodity. What that means is every ounce that leaves China has to get permitted through Beijing. Look, the European Union made silver a critical mineral 2 years ago. The world has growing concerns, if you will. Governments around the world have growing concerns about the availability of silver. And I think, honestly, that these countries, these nations will make efforts to not only reduce exports, which feed the markets, such as London and the COMEX, and by contrast or by extension, rather, the ETFs. I think that when you talk about could this happen, could we see that moment? Yeah, why not? I don't think it's imminent, but I think that there is a possibility. You look at India; their silver imports are up 500% year over year. One of the things that's most interesting is the sustained backwardation in silver. And I think that gets to what these people are talking about, because since early October, the silver futures curve has flipped into sustained backwardation. And it's not normal. It's unusual to see that in silver, period. And it's one of the clearest signs of I guess you could say, physical scarcity, um, along with multiple attempts to restore contango, where the futures price is higher than the spot price. But, you know, I guess we could just simply say, look, spot silver demand now exceeds futures supply. Um, the metal is genuinely scarce. That's not just theory. And there's no question that paper selling has and can and always has suppressed price, but it can't suppress the structure of the market. And I think that's where things get interesting. To me, the most condemning thing for the silver market, at least and supporting what they're saying, is that we've got about 7 or 8 days until the December gold and silver contracts go into delivery. And you can argue this is where paper meets physical, or the rubber meets the road. When you see silver 25 cents in backwardation, meaning the price is 25 cents, as it was yesterday, higher than the futures price, and as the futures price, as you know, and the spot prices get closer to that expiration, they meet, right? What it's saying is, and it's unusual to see in backwardation 7 days before these contracts come off the board or post, someone wants physical now, not later. And with inventories tight, immediate demand is outpacing expected supply. This doesn't happen right before the expiration, unless arguably there's a big move in store for us. I would think with people really trying, pushing hard to get silver in their hand before this happens. So yeah, I mean, I don't know that there's a imminent collapse January 1, but you can see that there are things that are unusual and could certainly continue to put stress. And then you add the countries like China who are going to stop the ready flow, at least it looks that way, of silver exports. You know, and in the U.S. making it a critical mineral, President Trump can do the same thing. No more exports, just like that. I think we're getting into that cycle, or that reality that physical demand is worth more than the paper underneath it. Who knows? Maybe they'll be right. But I don't like to go out on a limb and say January 1 things change. You know, I think it's very interesting in a world where Wall Street's never acquiesced to anything that you and I talk about, until all of a sudden the chief investment officer of Morgan Stanley says, you know, that 60-40 platform we've used, 60 stock, 40 bond, it's now 60-20-20. Sell half your bonds, put 20% in gold. Or Michael Hartnett, the chief head analyst for Bank of America, says, no, make it 25% in gold. Or Jeffrey Gundlach, the bond king, says, oh, that 25% is not overweight. You can see that things are happening beneath the surface at the highest level. And if just a little bit of these people, they're talking to the institutional level. I have a very good friend who runs $3 billion for Morgan Stanley. He wouldn't know a gold coin if it fell on his foot. He's in the top 100 money managers in the United States for Morgan Stanley. He doesn't know gold, yet their chief analyst, or their chief investment officer, says put 20% of your assets in gold. They're speaking to the institutional traders. And if just a few percent of those traders start to dabble in the retail market, it's going to have profound effects on premium and on availability.
Bill Holter explains that both gold and silver markets are undergoing significant shifts, with silver now more overbought than at its 1980 peak. He highlights that paper trading is waning while physical demand is growing, particularly among major economies like the BRICS nations, which are opening storage facilities and refineries to accumulate precious metals. Holter stresses that the market is in its 5th consecutive year of a structural supply deficit, meaning production cannot keep up with demand. This deficit, combined with ongoing price suppression in the paper markets, makes it increasingly difficult for producers to profit, further limiting supply and intensifying scarcity. Holter also warns that the manipulation of paper contracts has set the stage for a potential failure to deliver scenario in both gold and silver. When physical delivery becomes constrained, he believes fear not greed will drive massive capital flows from stocks, bonds, and even cryptocurrencies into precious metals. Given silver's relatively small market size and wide range of uses, industrial, technological, medicinal, and historical monetary roles. Holter argues that the surge in demand could overwhelm available supply. He emphasizes that unlike other assets, gold and silver cannot go bankrupt, making them the ultimate safe havens in a world facing economic instability. Let's get back to the interview.
Gold was overbought. Silver was more overbought than it was in 1980, back at the peak. And what you've seen with both of them are high-level consolidations. The paper trade is waning and the physical market is growing. The physical markets are growing. Just look at what the BRICS are doing. I mean, they're opening storage facilities, refineries. They're very serious about accumulating both gold and silver. And it makes sense because, for years and years, they had, I guess the metaphor is tons. They had tons of dollars on their books, and now they're adding tons of real money on their balance sheet. Yeah, I forget what the number is. It's something like 473 ounces or something like that. But yeah, that's silver that's obliterated. Can never be reclaimed. And this in a market that is now in its fifth year of a structural deficit, supply and demand deficit. Right. Well, obviously, price tells you that they're losing control, but let's not even talk about price. We did mention that we're in a structural deficit. We've had a supply and demand deficit for 5 years, and that's what happens when you get a small market size-wise as far as dollar amounts. I mean, the total production globally is only like $30 billion a year. But when you get a small market that's easy to manipulate, and if you're constantly manipulating to the downside and suppressing the price, what that does is it makes it much more difficult for producers to earn a profit, so they mine less silver. So, a direct consequence is the fact that we're in a structural supply deficit. Other things to look at, you can look at the lease rate on silver. You can look at the lease rate and the amount of shorts available on SLV, which is strictly paper. That's not actual physical silver. But the rates to borrow, it's blowing the shorts. The shorts are being blown up. No one can tell you that. And if they do, they're making up a number. I've said for years that on gold and silver, the numbers that we're going to go to are higher than anyone has projected of any number for gold or any number for silver. The actual number, I'm convinced, is going to be far higher than the most optimistic projection there is. And the reason being, gold and silver what they've done is they've sold paper contracts. We're going to move into a failure to deliver scenario. And when that happens, man is a funny animal. When you tell man he can't have something, he wants it that much more. I mean, you're talking literally trillions of dollars that are going to be dislodged from the stock market, from the bond market, even from the crypto markets. And all that money is going to be pointed toward gold and silver. Those markets, I mean, especially silver being so small, they cannot handle the type of capital that's going to be heading toward a safe haven or the safe havens. And one other aspect of man, fear is the greatest emotion there is. And people are going to be moving money into gold and silver, not out of greed because, I can buy gold at 50 and I can sell it at 100 or 200 or whatever. That's not going to be the motivator. The motivator is going to be fear of losing everything in other markets and putting that money into something that is a safe haven and cannot bankrupt. That's the whole key. They can't bankrupt in a world that is defaulting. Silver's got many, many uses. It's not just industrial. I mean, you've got technological, you have medicinal. I mean, go back hundreds of years. You remember the term, he was born with a silver spoon in his mouth. Only the wealthy people could afford silverware. And the reason they used silverware was because the antibacterial that properties of silver. Right, exactly. Gold is basically strictly money. Silver for several thousand years was also money, but it has other uses. It has more uses than any other element on the planet.
Both gold and silver are experiencing unprecedented market dynamics driven by growing physical demand and constrained supply. Governments around the world are treating these metals as strategic assets, restricting exports and building reserves, while institutional investors are increasingly allocating significant portions of their portfolios to precious metals. Structural deficits, backwardation in silver futures, and the manipulation of paper contracts indicate that the market is moving toward a point where physical demand may overwhelm available supply. Coupled with widespread fear in traditional financial markets, this convergence suggests that capital flows into gold and silver could be massive, highlighting their enduring role as safe haven assets in an increasingly uncertain global economy. How could the growing global demand for physical gold and silver impact prices and availability in the coming years? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.